China's under-pressure economy is displaying more signs of stress on multiple fronts.
China's economy is facing some serious challenges. Retail sales, industrial output, and investment are slowing down, raising concerns. The property sector's liquidity crisis is a big worry, affecting spending and financial stability. Now, China's central bank has cut interest rates to encourage more lending to businesses and consumers. Let's explore what this means for the economy. China's economy has a much-needed shot in the arm, and the country's central bank has made some significant moves. Picture this. They've decided to lower the rate on their medium-term lending facility by 15 basis points, setting it at 2.5%. Additionally, they've trimmed the 7-day reverse repurchase rate by 10 basis points. Now, let's dive into what this all means. You see, in the grand scheme of Chinese policy, a 15 basis point cut is quite substantial. Typically, adjustments hover between 5 and 7 basis points, making this move stand out. But why the deviation from the norm? Well, let's take a step back and look at the broader economic picture. China is facing some rough waters, with new bank lending at its lowest since the global financial crisis. It's a bit like steering a ship through stormy seas, choppy and unpredictable. So, what's the central bank's plan of action? By lowering these rates, they're aiming to make borrowing a bit more attractive, hoping to kickstart economic activity. It's a bit like offering discounts at a store to entice shoppers. Except in this case, the discount applies to loans. Consumer and business confidence hitting rock bottom. Picture this. Folks are hesitant to take on new debt, whether it's individuals tightening their belts or businesses hesitant to expand. Why the hesitation? Well, for starters, business conditions aren't exactly peachy, and many households and businesses are already weighed down by hefty debt loads. It's like trying to convince someone to buy a new car when their old one's barely running. It's not an easy sell. Instead of splurging, folks are opting to save and chip away at their existing debts. Now, let's talk solutions. Sure, lowering interest rates might make borrowing a tad cheaper, but it's not a magic wand that'll instantly boost spending and investment. See, there's a deeper issue at play here, a lack of underlying demand and confidence. It's a bit like trying to fill a leaky bucket. No matter how much water you pour in, it keeps trickling out. So while cutting rates might sound like a quick fix, it's just one piece of the puzzle. It'll take a whole lot more than that to breathe life back into the economy. When it comes to piecing together the policy puzzle to tackle issues with sentiment and confidence, there's a whole array of moves that need to be on the table. You see, the economy's riddled with imbalances right now, and addressing them requires a multifaceted approach. First up, we've got monetary policy, tinkering with interest rates and such. It's like adjusting the thermostat to find that sweet spot of economic activity. But that's just the tip of the iceberg. Enter fiscal policy, basically. How the government spends its money. Think of direct investments in infrastructure or incentives for businesses and households to open up their wallets. With consumer confidence at an all-time low, these kinds of incentives could be just what the doctor ordered. Then there's the nitty-gritty stuff, like industry-specific incentives and regulatory tweaks. It's about clearing away obstacles and greasing the wheels of the economy to get things moving again. But here's the kicker. The old playbook might not cut it this time around. We're dealing with a whole new set of challenges, so it's going to take some out-of-the-box thinking to find solutions that stick. It's like building a house. You need the right tools for the job, and sometimes that means trying out some new techniques. Looking back over the past decade or so, China has often relied on certain strategies to jumpstart its economy during slow periods. One common tactic was to increase spending on infrastructure projects, or to facilitate more property development by selling land to developers. These methods were like go-to recipes in the economic cookbook, reliably churning out results when the going got tough. However, the situation today is a bit different. China finds itself in a unique position where the old tricks might not be as effective as they once were. You see, the country has already seen massive growth in its infrastructure and property sectors. We've built plenty of roads, bridges, and buildings over the years to the point where further expansion in these areas might not yield the same economic boost as before. It's akin to trying to squeeze juice from a squeezed-out orange. There's just not much left to give. So, what does this mean for China's economic playbook? Well, it means we need to start thinking outside the box. While infrastructure spending and property development have been reliable go-tos in the past, they might not be enough to stimulate growth this time around. Instead, it's time to explore new avenues for economic revitalization. That could mean investing in emerging industries like technology and renewable energy, or focusing on improving social welfare programs to boost consumer spending. By diversifying our approach, we can adapt to the changing economic landscape and find new sources of growth. But that's not the only challenge we're facing. There's also the issue of missing data on youth unemployment rates. Now, in times of economic uncertainty, access to reliable information is crucial. It's like trying to navigate through a dense fog without a compass. You're left feeling disoriented and unsure of which direction to take. Without accurate data on unemployment rates, policymakers and businesses are operating in the dark, making it difficult to gauge the true state of the economy and make informed decisions. Transparency is key, especially during turbulent times, and withholding important economic data only serves to exacerbate the uncertainty. So, what's the solution? Well, for starters, we need greater transparency and accountability when it comes to reporting economic indicators. This means ensuring that data on key metrics like unemployment rates are readily available and accurately reflect the current state of the economy. Additionally, policymakers need to adopt a more proactive approach to economic management, one that emphasizes adaptability and flexibility. Instead of relying solely on traditional economic stimuli like infrastructure spending, we should explore innovative solutions that address the unique challenges facing China's economy today. One potential avenue for stimulating economic growth is through targeted fiscal policies. By providing incentives for businesses to invest and consumers to spend, the government can help spur economic activity and create new opportunities for growth. This could involve measures such as tax breaks for companies that invest in research and development or subsidies for consumers purchasing environmentally friendly products. By strategically deploying fiscal policy, China can encourage innovation and entrepreneurship while also addressing pressing social and environmental issues. Now, removing certain economic indicators from consideration doesn't necessarily provide much relief when it comes to understanding the state of the economy. Take, for example, the youth unemployment rate. While it's true that this data series has its flaws, like any other, it still offers valuable insights into economic conditions. Unlike the total unemployment rate, which tends to remain relatively static, the youth unemployment rate is more responsive to changes in the job market. This makes it a useful gauge of economic health, as it provides a more dynamic picture of employment trends. Sure, there may be some seasonal fluctuations, especially during the summer months when graduates enter the job market. But overall, it's a reliable indicator of labor market dynamics. It's worth noting that statistical agencies worldwide are constantly refining their data collection methods to improve accuracy. However, this doesn't mean they simply remove a data series from consideration until it's perfected. Instead, they work on refining it while still making the existing data available. This allows for a continuous assessment of economic trends and ensures that policymakers and businesses have access to the most up-to-date information. So, while it's understandable to strive for improved data quality, it's important not to overlook the valuable insights that existing data can provide. After all, in the ever-changing landscape of economics, having access to timely and reliable information is key to making informed decisions. Anyway, it's clear that navigating the complexities of China's economy requires a multifaceted approach. From exploring innovative solutions to addressing long-standing challenges. So what do you guys think? Drop your thoughts in the comments section below, and we'll meet again in the next one.